The first stock I ever bought was 100 shares of Hallmark Technologies. It was $4.50 a share. I was 18 and I had just become a capitalist. This is Terry Hogan Talks Stocks, where we bring on investors and we ask them to tell us their first, their worst, their best, and their last investment. We see if we can learn from their successes and their failures. Now, Hallmark Technologies, my first purchase, was a micro cap. It was trading with a market cap of around $25 million at the time. One of the reasons I found it was because it had a low PE, and I just finished The Intelligent Investor and figured I was going to be the next Warren Buffett as a disciple of Ben Graham. So I was looking for value stocks, and this one seemed to fit the bill. The other reason I purchased this was because my brother worked there, and I figured I had some insight into this stock because I knew people who worked at the company. So that brings us to the first guest we're going to have here on our show, my brother, Chris Hogan. All right, today's guest is Chris Hogan. And Chris, just to make things clear here, when I Google your name, it comes up with a finance expert who wrote a couple of books, worked with Dave Ramsey. That is not you?
No, that is definitely not me.
Okay, second one on there is a wide receiver who won 2 Super Bowls with the Patriots. That one's not you either?
Even more unfortunately, no, that is definitely not me as well.
So, Chris, you're my brother, and that's the first reason why I had you on here. But also, the first stock I ever bought is from one of the companies you used to work at, but we'll get to that. So, you didn't go to school for finance. You did a diploma at St. Clair, and that was was it computer networking?
Computer science, more of a general, it kind of encompassed, the programming aspect, the networking aspect of computers, technology, etc. And then you could branch from there. But I did initially focus on the networking part, and then afterwards I kind of veered from that and got into more of the hardware and software kind of. But yeah, and that's what I've been doing ever since. And now I am a computer systems coordinator at a children's aid firm for about the last 10 years and loving it.
Now, but you had started work at what? Like, were you 14 when you started working?
Yes, 14. At a friend of mine their parents owned a landscaping / trucking company. So they got me in there, and it was hard work, but no, it was good experience nonetheless. So I did enjoy it, and I was there for about 10 years. It's tough work, don't get me wrong, but no, it kind of gives you a good idea. It builds a good work ethic for you.
Now, what would they start you at hourly back then?
So we got to actually 14. So you're probably putting at, what's that, 35 years ago now, I believe. I just dated myself. At that time, I believe I was paid $4 an hour.
Actually, that wasn't too bad back then for farm, because you could buy a taco or something for 49 cents, I think, at Taco Bell in those days.
Yes.
Wasn't great money, but
the wage at the time was relative to the cost of things at the time. Was it horrible? I mean, now $4 an hour. I mean, oh my God, you couldn't buy a pack of gum in an hour. No, back then it did. It kind of, relative to everything else, it was okay.
So now, how did you get into investing?
So if we work so hard for our money, would it not be understandable to kind of not to actually save some of that money, kind of watch how you spend it, be responsible with your spending, that sort of thing. So with that being said, I took on that kind of thought process and started to figure, well, okay, I'm making money now. What I need to do is, how do I grow that money? How do I responsibly manage the money that I'm making? I did realize early on, a standard bank account, everyone has their bank account. Hey, I deposit my money into a checking, a savings account, maybe that's a little higher interest. But inevitably, you want to grow that money using different methods that'll get you a little better return.
And back then, we might get at least like 4% or something. Looking back, I'd kill for 4% in a savings account nowadays.
Absolutely, I totally agree. And comparative to now, it does look very good. From my perspective, it was, well, I always wanted, you want to make your money work the hardest for you. And I kind of really believed that I need to get this out of those standard checking savings accounts into something else, maybe mutual funds. I wasn't too familiar with the stock market at the time. It was really new to me, but I knew that there was, these financial products offered by the banks and other brokerages, etc. That
So
could
you're about 19 at the time? Is that where you're talking, or a
I
bit
want
older?
to say around 19, yes.
Yeah.
18, 19. I had been working for, 4 or 5 years by that time, saving my money. No, of course, you're the teenager, right? So teenagers love to spend their money, of course, for the most part. But I
I
want,
recall a convertible somewhere along the way
that is correct. Yeah, yeah,
with some
making it,
big speakers.
I want to say that, yes. Not impulse buy. I wouldn't say impulse, but you do have at that particular age, there was, hey, I'm making money. I deserve to reward myself some of the time. So that was kind of that was definitely an automobile that I did have. But at the same time, with those expenditures, I realized, as fun as it is to spend the money and buy these kind of toys, I guess, if you will, I needed to put some of that earned money away or set it aside. You never know. I mean, the future, we don't get younger. We just age as time goes on. And I do believe it is never too early to start saving, to again, that's that financial, I guess, responsible financial planning, etc. So I did put away some of that money. Now at this time it was still in, let's say, a standard savings account. I didn't know too much, maybe like you said, earning anywhere from 3, maybe 4%. You want to make your money work harder for you. And that's when I started to looking into, hey, how do I do that? How do I grow this money at a faster pace? I want more than 3 to 4%. How do I do that?
Okay, so then let's get down to it. What was your first investment?
Because I was relatively new to how to properly invest and how to go about doing this, did visit my parents at the time were dealing with a particular financial advisor,
Oh, yes, I recall.
kind of more or less a smaller organization, not any of the big banks. They offered tax preparation services. They sold mutual funds, etc. That, and my parent had been with them. So me being new to this, I said, well, you know what? Why don't I start there? They're entrusting their money with
Sure.
this institution. So okay, I might as well do that as well. Again, I was brand new to this. So I arranged the meeting, and yeah, I went into this particular institution. I sat down with them and said, hey, what? I want to start developing a regular savings plan. I want to grow my money, start preparing for my future, etc. What do you recommend? So, it didn't take too long before, they recommended some strategies for me. At the time, we didn't really get into stocks and individual stuff like that. They were more of a safer play than that. They didn't want to really do too much like that with me in particular, being new to the whole investment landscape. So I was recommended at the time, mutual funds, the safest kind of bet. It's the most common thing, hey, the vast percentage of regular investors usually would have some form of mutual funds. So I agreed. To get into specifics, unfortunately, one of the first investment opportunities they did bring up to me was a labor sponsored investment fund. And
Yes, yes, I remember these.
so the reason this was suggested to me was this particular one. It was Vengrove, based out of Toronto. And why this was recommended to me? It was a type of mutual fund, and the attractiveness to this particular fund was the fact that there were initial tax credits offered both at the provincial level and the federal level, which
Right.
15% on the provincial level, as well as 15% in most cases at the federal level as well.
Right.
So what that means was, say $1,000 investment. I bought into $3,000 with this. You could at a 30% tax credit. You could almost see immediately a $1,000 or one third, 30% return on your investment, or not return, but I guess in the form of a tax credit. So
Yeah, so you're getting 30%. Basically, you're getting a 30% return right off the bat. You're thinking, hey, this is a good
correct.
deal.
Correct. So
Yeah.
that looks very attractive I mean, that would look very attractive to anybody, of course. So me being brand new, you mean I can give you $3,000 right now, and they're gonna give me 1,000, the governments are going to give me $1,000 back. Well, fantastic. That sounds absolutely amazing. So without reading too much into it, and I didn't ask a lot of questions, again, being new to the whole investment landscape, we kind of went ahead and went with that. Now, at
Well,
first,
prior returns are no guarantee of future results,
of course, and that's
but
generally
you didn't. I don't think any of us looked at the prior returns, or they didn't have many at that time for these because they were newer
no.
funds, I think, right?
Because they were newer products, I believe, there wasn't a whole lot of past performance information available. Unfortunately, now being at the point in my life where I am now, I mean, I usually that's one of the key metrics I do look at, obviously, and I believe everyone should. But no, at the time, there wasn't. These were relatively new products. So again, with the promise of these instant large returns, it seemed like an excellent choice. So we went ahead and did that. Everything for the shorter term, a couple years, everything seemed okay. They were kind of stagnant. These particular things, by the way, they invested in. They were almost like a venture capital type of investment. So they were
Yeah, that's what they
trying
were
to.
marketed as.
Yes. So what that generally meant was they would invest in these kind of up and coming companies, maybe speculative, with the hopes that these companies kind of hit it big. Now, of course, anyone will tell you that there is substantial risk in investing in any of these newer venture capital type projects. So, a lot of things, if something doesn't work out, these things can go belly up very, very quickly. So it was that risk factor that I really wasn't made aware of at the time when I was being pitched this. It was more or less, hey, here's our returns. Look at these attractive returns. But, I wasn't
Yeah,
told.
tax based. The returns were tax based, right?
They were, yes.
Yeah,
And but at the time, I wasn't really made aware of the inherent or the potential high risks of this particular vehicle
yeah.
investment. So, long story short, what ended up happening, these things, a lot of their investment, a lot of the companies, etc., that they invested in didn't end up panning out. And the trouble was with these, a lot of the money that was in these particular funds, they became locked, or the assets within the funds became frozen.
Right. You couldn't, there was a period where you couldn't withdraw. And then I think they would let you withdraw because I know mom and dad had some of these and you could only withdraw on like a certain date. And if, yeah,
Yeah,
it
they
was
made
hard to
it
get out
very.
of.
Absolutely. They made it very complicated to take your money out of the fund. When as soon as I started realizing, I don't think this is for me anymore, let's kind of cut our losses, or we might be at a break even point by the time you work in, the initial tax credits. It was pretty much near impossible to do because it was frozen. There was no redemptions allowed. So you had to hold on
Yeah.
to uh to the money that was in there. And this went on for, this wasn't months, I mean, this was years, until finally this vendor was bought out by another company. Again, though, you could not do anything with your money. There was hopes that this other company would be able to turn the fortunes around, but
Yeah. That
that
was
never happened.
Covington, I think.
That was Covington, and there was still, unfortunately, you could not redeem your funds. And I would follow up, year after year, being forced to hold these. I'd ask the financial advisor, hey, any updates or news on this as to when we can pull this money out? And unfortunately, no, it was, you really couldn't do anything. I mean, the managers were still getting hefty termination fees, etc. I
Yeah.
did
And I
look
think
into.
they had relatively high, it was a high expense ratio. I
They
can't
did.
recall what it was, but I remember it being high.
It was. I'm not sure the specifics, but I know they got paid. And as
Yeah.
is the case, you hear often. So there were clauses in there that none of the regular, I guess, mom and pa investors could take their money out, but the fund managers got their bonus paid out of that pool. So you really have to, that opened my eyes to how you really have to look at the management structure and that kind of thing, as to how things work should things go south. Who gets paid first, essentially. It was a hard lesson. I believe what happened was we were able to transfer finally those, whatever little was left of the fund. I want to say, we got about 30 cents on the dollar. It was a rather big loss at the end of the
Yeah.
day.
So you're probably talking at like half, like 50%
Probably,
ish.
even taking into consideration the combined 30% tax credit, definitely not a good investment.
No. And, so that's funny because that's your first and that's also your worst. Is that right?
I would have to say
Yeah.
that's definitely up there. with my worst as far as, I guess, long-term holds. And in that case of the Venn growth stuff, that was my plan. But that long term, hey, wait and grow my money approach backfired on me, in a bad way. So I
You
do
know,
like.
though that was a good lesson I found for me too, because I remember the financial advisor that sold those to you and to our parents. I remember we went to her offices one time and I saw out front that she was driving a new Mercedes and we had driven there. I think it was probably in a Dodge Caravan or something at the time.
Yeah.
And I kind of registered the fact that who is earning the money in this setup.
Yeah, it's something you definitely notice, but again, like you said, it was a learning experience. Kind of forced me to do more of my homework or reevaluate some of the different ways that I intend to invest my hard-earned money when the time comes. So it really made me open my eyes and say, you know what, I have to do my homework, and I really want to ask the questions. Don't ever be afraid to ask the questions if you don't understand the way a financial product or in a particular investment works. It is key because at the end, this is your money, and you definitely want to see the value of it increase rather than decrease.
Now, I don't know, do you think it was worse watching it decline over such a long time and being unable to do anything about it? Or is it better to just, the market opens the next day and it's dropped 40%? Like, I don't know. Emotionally, was it harder to deal with watching it that long time?
I mean, it, yeah, it was tough watching. It was really disheartening at times. It might be a little less painful than an instant drop of, say, a company reporting bad earnings or guidance or something like that, and instantly dropping 35% the next day. That is a quick, swift punch. Unfortunately, I've experienced both, and generally, the quick, swift punches are tougher to handle. But
So
again,
it's like boiling a frog or something. Was that
yeah,
what
yeah,
was happening to you?
exactly. But over time, and as you continue to invest and learn more about the different ways you can try to grow your money, you learn to manage the emotional part of it as well. You tend to at least hopefully get better at it. I find I've gotten quite a bit better. There's still times emotion plays a little bit in decision making, but for the most part, you learn to kind of handle that, and you have to. You definitely have to.
All right. Well, then let's get to what is your best investment you've made to date?
All right. So great question. Once I moved out of the labor sponsored stuff, and I started thinking, well, I need to learn on my own on how to, I want to be more actively involved in my financial decisions. I don't necessarily want to have somebody else dictating where my money goes. So I did end up enrolling in a financial and actually a trading club. It was offered by an economics professor here at the University of Windsor at the time, who actually he traded on Wall Street for a number of years, and was offering this newer course to interested people who want to kind of start actively trading. They want to learn how to trade on their own, in the stock
What
market.
was his name? Do you remember?
His name was Mark Meldrum.
Okay.
Yes. And so I had come across this advertised in the paper, and I ended up, attending these classes, as did a large group of people. And I did that for a number of years.
Now, would he walk you through trades that he was making, or did you guys pool your investments? How did that work?
So he did both. There was both offered in that trading club. In the early going, it was just strictly kind of a learning. Basically, what is the stock market? What are the major indexes? The Nasdaq, the Dow Jones, the S&P 500. There was a large focus on US based, as it was, hey, let's first introduce the members of the group to what the stock markets are, how things trade, the fundamentals, before we gently start getting into, okay, how do we execute these trades? How do we go about actually buying a particular stock, maybe an index fund, and selling them? And what are some of the different strategies you can use, as as time goes on. There's not just, hey, buy X amount of these shares and at this price point and sell them higher. There's options. So all kinds of stuff that we started to get into as the weeks, months, years went on. And to answer your other question, yes, there was a lot of specific trades that he outlined that he was making. There were suggestions to the group as well, and we would specifically from week to week go over these particular trades. I mean, it was, hey, we're buying this many shares of this particular company because they're reporting earnings in a week, and we kind of,
Yeah. Did you follow along with any of those? Did you do any of those, or
oh,
can you
absolutely,
remember
I
any
did.
specifics?
I do. So what was really neat was he was able to secure the trading room at the university. There was an actual open trading room at the university, and he would carve out blocks of time during the trading day where his group could come in and actually perform real time live trades. While he was present and offering the advice, the members of the group could actually go there during the day. And I remember specifically, this is when BlackBerry at the time was very active,
Oh yeah, it used to be hot. Yeah, I
and
got
there
burned.
was,
It was so hot I got burned on it once.
yeah, exactly. I remember there was a short while, a few times I went in, and it would be so specific that you would watch the tickers up on the wall, and BlackBerry would hit a particular price point, and Professor Meldrum would be, okay, great. BlackBerry is a buy right now. If you look at the volume, we would have the technical analysis charts there. And based on that information, we would make decisions right down to the particular penny as to what we should do next. BlackBerry is a particular one. It was, okay, buy now. And we're talking within maybe 20 minutes, 25 minutes, it might raise, 2, 3% based on technical analysis. I remember, okay, it's a sell now, right now. And based on that, a lot of people did that, myself included. I remember making a decent amount of money, 20-year-old kid making,
Yeah,
$500 on,
yeah, yeah.
when you're in university and making $500 in 20 minutes, who wouldn't jump in on that? You know what I mean? And I remember
Well, and that
specifically,
was the heyday of day traders, right? When people were trying to stay home and become a day trader. That was quite a big thing at the time.
I think, yes, that was when people were getting big into it. Even now, 30 years
Well,
later,
sure, and during COVID, right? Like,
well, of
that became a
course.
thing. People cashing
Yeah.
their COVID checks and buying
Yeah.
GameStop.
Exactly. There still is a high interest. If you look at volumes and you've got, the kitty, who's that? There's the one guy that
Bad
always,
kitty.
yes, you really have to be careful. I think that some of these influencers can just on the merit of a statement itself can send wild swings on stocks. And so I do tend to avoid that for the most part, but I do think a lot of these people, they're not professional day traders. They might just be, regular folks, students, retirees are taking part in because of the online availability, the ease of making these trades now with all the major
Sure.
banks.
Now you got zero commission options in certain
Well,
places.
exactly, which I do like, by the way. I like that ever since my platform, it is a lot easier to make smaller trades because you don't have to account for higher commission fees. The experience with the in that class with the real time trades, that was pretty neat. I will say, and that's what kind of got me. I was hooked after that, just watching the way that he could make a decision based on, how a particular chart is showing for the day or the month, and watching the volume swings on a particular stock. So learned a lot that way. Definitely. It was definitely a good learning experience.
Okay, so what was your best then? What is your best investment today?
As much as I love the excitement of trading individual stocks and watching how they move, and this could go one way, this could go really high in a short amount of time, or this could go unfortunately wrong in a very short amount of time. I would have to say my best investment is a technology fund that CIBC offers.
Oh, okay.
It's actually a mutual fund, but just tracks the NASDAQ index.
Oh, okay. So basically a NASDAQ index. Okay.
And
Yeah, well, I guess over the past 15 years, you'd have done well for sure.
the reason I do like some of these, bank based, and this is purchased through my financial institution. I do like these because I'll look at the management expense ratios, and I like to pick ones that they have to be relatively low. I do like low management fees, so a lot of your money isn't getting paid out to these managers, or any kind of gains are quickly eroded by high management fees, right?
Well, sure. And I mean, people don't realize that, right? They look at it and they go,
No,
oh, it's, 2%. That doesn't seem like a lot of money. Well, 2% is huge over
which is
30
which is
years.
huge.
Adds
Yes,
up.
I generally try to keep mine under, underneath 0.4%. And I do stress the importance, if you are going to go that route, make sure you look at those management expense ratios or MERS and any type of other fees before getting into them. So I would honestly have to say, there is those those tech funds are doing very well. Now, mind you, they ride their ups and downs, as we all know. A financial crisis comes along every now and then. I'm sure people would bring up the .com bubble
Well, you
many years
probably would have
ago.
started this basically right after
Pretty much.
the the
Yeah,
tech blow up, right? So that's a pretty good timing on your part in some sense, right?
it is now. I mean, you could. There is a strong argument. Well, what is preventing another tech bubble? I don't know. I would.
Yeah, yeah, no, I know right now. And I mean, we're recording this. This is July 1st. So, I mean, we're hitting all-time highs every week. So, yeah, I know it's
Absolutely.
yeah, it's reminiscent of that era.
I do like the outlook for the US markets. I mean, regardless of what your political thoughts are, et cetera, I do think the US markets are very strong. They're very resilient. And the US economy is still a powerhouse, and it has been. And
Well, that's one of Buffett's sayings, if you never bet against the US economy, right? Like
no,
it's done well for the past 100 years, yeah.
and that's a great point you bring up. Don't bet against the US economy.
Okay, so now just to prove that we're all just big dumb apes here trading, you just talked about how your best investments are the ETFs and the long-term holds and, mimicking the economy. Now let's get to, I want to know, what is your most recent trade or investment?
Okay. So I don't classify myself as a day trader, so to speak. When I say day trader, I see someone who's in and out multiple times throughout the day. That's kind of my
6 monitors set up in front of you, Bloomberg terminal.
exactly. That's kind of my day trader. I don't consider myself a day trader. However, I do have account with an online brokerage, again, with those low fees. Thank you very much. That I use to satisfy my need to be in the game. And that was a term that Mark Meldrum had kind of emphasized during those days, whereas it's nice to be in the game, meaning have a position, watching and monitoring that position and looking for these big swings in the anticipation of a large move, hopefully to the positive. But
Well, it's exciting, right? It's exciting. It
it's
scratches that
absolutely
itch, that
exciting.
need for I don't know, excitement, adrenaline.
Well, of course. And I believe it is important to, while satisfying that need, to do it in a safe manner. I have enough restraint that, when I want to be in the game, so to speak, I do it in a way with a separate kind of account, on a much smaller scale than my larger, safer, slower plays, retirement, etc., sort of thing. There's not ever going to be a huge moment where, oh my God, this one really hurt me. I've got to file for bankruptcy. I never will put myself into that position. And I believe that's very important for people to make sure they are aware of that. And just so they don't, because you can definitely, the emotions run high, and everyone wants to ride the next big wave of this stock or that stock, but you really have to have a restraint in place or some form of self-control, just if you are going to move forward in this.
Now,
Getting
this
to
is all
that.
in the tax deferred accounts, so that at the end of the year you're not having to file on 7
Absolutely.
different options trades.
And perfect, especially for day traders who can make thousands of trades in a year. If that is in a non-registered account, you will have to report that on your tax returns and so forth, as far in the form of capital gains or losses. That can be a daunting task come tax time to report all that. In the early goings, I had to do that and spending hours and hours reconciling these trades just so you wouldn't run afoul of tax rules and so forth, until the TFSAs kind of got brought into play.
Like that's like having a Roth IRA in the States.
Yes.
Yeah.
Okay. Perfect. Yeah. Yeah. So that's generally where I do the bulk of my trading. I prefer a strategy called selling covered calls. I've got a number of key stocks that I am holding, and I as long as you have 100 shares of the underlying stock, in most cases you can take part in the options market, or at least the covered call portion of the options market. What I have been doing is recently selling covered calls and just rolling them, a couple weeks out every single time. You can sell covered
Now,
calls.
so you have to be dealing with like something that's relatively high price or per share or relatively volatile if you're selling them 2 weeks out, right?
Yes and no. This actually is the latest that I did.
Okay.
So with getting into it, I hold 100 shares of a company. It trades with the ticker UPST. It's Upstart Technologies, and so
Right.
I
And they're like we were talking about this the other day offline. They do AI bank approvals or loan approvals or something like that. They
yes,
run back end.
yes, somebody comes for an auto loan, and their software will determine if somebody applying for these loans, if it's a safe loan to make, based on a number of different artificial intelligence metrics that are run against this. It's almost like an automated credit check, but a lot more in depth. It tells the lender, hey, is this a risky loan that I might be looking at, or is this generally a safe loan for us? They essentially use the Upstart's technology to determine that for them, saving a lot of time, a lot of effort, etc. So
Did you
basically,
buy this with the intention of selling the calls, or were you more interested in you're buying this as a good company that maybe you're going to hang on to, or is it a little bit of both?
so that's a little bit of both. A good question. I first got into this actually from just reading The Motley Fool at one point in time.
Right, right, right.
So
Yep.
I was a member there for quite a while, and that's the first I've heard of this. So I investigated, I read up on it, and I found I liked the mandate behind the company, and I said, this is something with a decent outlook, and it was at a price point. Now, this is a number of years ago, so I've been in and out of this stock quite a bit. So I probably got into it maybe 3 years ago now, and then
Okay.
I've sold my positions in it. The first trade I made was with the hopes of the stock appreciating in value. It was strictly for stock appreciation, and the outlook for that was really good. So I played it as that for a while. Then as the stock moved in price, I started looking at the options for it, and then I decided I was comfortable selling covered calls with this particular stock. And again, basically why I like doing the covered calls is it's almost as if you can stay in the game. You can hold these underlying shares, yet you can, as long as you strategize well enough, you could still end up making money by selling these covered calls and yet still holding on to the stock if they do not get called away from you. And that might be a discussion for maybe another podcast, again, with the in-depth strategies of how to do this. But to answer your question, what I have been doing with Upstart in particular, I think the last buy-in, I want to say a month or two ago, was I had bought 100 shares of Upstart. I think it was $88 at the time,
Okay.
which was relatively high. It just had a big jump. You might say, well, Chris, why did you buy the shares when they were at a very high, they had just
Oh yeah,
experienced
I'm looking
high?
at the chart here. Yeah, so 88. You're talking probably February, end of
Yeah,
February, early March. Okay.
exactly.
Oh yeah, it's been a rough ride since then.
Absolutely, it has. To your
But we're at
listeners,
84 today, up a bit.
exactly. Today's been actually a decent day. I'm just
Okay, so what's your most recent trade? You sold a
so
covered call on Upstart.
if I purchased and I own 100 of those Upstart shares at $88, that is going to cost me $8,800. The thing is, you can generally sell the covered calls. They're going to be high. If that had a 5, I think that was that might have been at a 10% move, to be honest, when I bought those. The option premium to sell those are very high as well. They're super inflated. We're talking double digit
That's when you're
inflation.
collecting bigger premiums, is when the movement of the stock is bigger. Yeah.
Yes. Normally, what I would do is I would almost at that point in time sell the $88 calls, but probably at a premium. I can't remember. It might have been $4 or $5 at the time. So you get an instant $400 or $500 back into your account. By doing that, you've actually lowered your account of, say it was $500. You've actually lowered your average cost of those to 88 minus, say it was $5. You've actually now, your total cost was $83 per that upstart.
And you're dealing with zero commission options, zero commission trades in your account, or
Yes, the commission would cost me $1 right now. Yeah.
per contract?
Yes.
Okay.
So $1 to which is, the point is irrelevant when you're dealing with, yeah. So they did, because usually there was a flat fee a number of months ago, and they eliminated that. So now it's pretty much just $1. So what we're doing here is, by doing those, and the reasoning behind this is, I don't really care if, for me, that stock would have to drop down to to under $83 for me to um to start losing money, I guess, if you will. Because remember, I've already got the $500 back for selling those covered calls. Now, here's the caveat. If that continues to run in the next 3 days to $97. Well, the thing is, I've sold the $88 calls. I have to give them up at $88. So I get none of that upside potential. You are foregoing that, which in this case I was comfortable with. I'm buying something for essentially at $83, and I sold it for 88. So great, a $500 gain. My current position, they did not get called away from me. That stock did. I figured there would be a pullback in it. And actually, it was a drastic pullback, as if anyone pulling up the chart would see. This
I
thing
see
dropped
that.
almost 50%. I think almost 50% at one time.
Yeah.
I wasn't too concerned at the time because I had liked the company, so I didn't mind holding those shares. The trouble is, when it slowly comes up, you can't just continue selling covered calls, because there would be no money in it. I would have to sell something in order for me to not lose any money. I have to sell $83 calls, but they're going to be worth nothing, because the stock price was, I think, around
Yeah, you probably can't
$48.
sell when you're at the lowest of lows of $31 or
Well,
something like that. I
you're
think it hit.
handcuffed. You're
Yeah,
pretty
you
much
can't sell
handcuffed.
at $83
You
call.
cannot take the risk and sell those calls. So basically, no problem. I'll keep and hold this stock, because I don't mind holding a stock. It's going to rebound. I'm pretty confident, and it has rebounded. So once it gets up to that, now I've sold other options. I think a couple weeks ago, I can't remember what I did, but now my latest was, I think, a week ago, when the stock hit around $83. I ended up selling the August 8th $88 calls for, I think I got $7.75 for those. So that's an instant $775 in your account. Now that lowers my average cost by $7.75. So I don't really care if those things get called away from me at all. If it hits $83 or
If you ignore any kind of any calls that you sold in the interim, just assuming you bought it at 88 and then 2 weeks ago you sold those calls for $700, $88 calls, you're making $700, ignoring all the other ones you sold. And
ignoring
since
the
you
other,
sold other
correct?
ones in between, then
Absolutely.
you're coming out well ahead of that. And if the stock continues to rise, well, you give up some of that upside. But if it tanks again, you've protected a bit of your downside. So they kind of have the effect of smoothing out
Yes.
the returns.
Like, if you really like holding, or really like the fundamentals of a particular company, but you think they might just move in a sideways pattern, you then sell sell the covered calls, because you're in the game. And it's a lot easier to stomach missed upside than it is to suffer a staggering loss. I'm not sure what's going to happen, but if earnings are good, this thing could shoot to $95 very, very easily. And I would miss out on that upside. I wouldn't care a bit, because of my average cost is, I
And you've locked in over a 10% return in,
Oh,
let's call it 4
easily.
months,
Yeah, I
5
want to
months.
say I think my average cost with this is somewhere around $73. So I'm totally fine with it. However, if say earnings miss on the 5th, this is probably going to plummet, and that means I'm going to keep those.
Well, and if you look at that chart, then that tells you what it's like to own individual stocks. And even after our whole conversation here, talking about the money you made in different trades, you said your best is an index fund. And I think that's a good take home message. We've been speaking with Chris Hogan. Chris, can people find you are you on Twitter or Instagram or anything like that
You know what?
that you want people to know about?
I, I'm actually, I don't have a very large social media presence. To be honest, I think you mentioned earlier, a search for me will turn up a lot of pretty much everybody who is not me. I don't have much of a social media presence, unfortunately. I kind of stay off the grid that way, to be honest. Yeah, I mean, but probably, yeah, not the answer you're looking for, but no, I don't have a big a social media presence.
Okay, well, thank you for joining us. We've been talking to Chris Hogan, who is not a finance professional, but he is my brother and our first guest on the podcast. So thanks for being on, Chris.
It was my pleasure. No, anytime. That was fun.
So to review Chris's investments, his first and his worst investment was in a labor-sponsored venture capital fund. It was a fund that was sold to him by investment advisors. He didn't really understand the product at the time, as he told us. And it's a good lesson that we should understand what it is we're buying and try and do some of our own due diligence. His best investment was in a long-term hold in an index fund. And I think that's a good lesson for all of us. His last trade, as he detailed there, is in Upstart Technologies. Now, remember that everything here is for entertainment purposes only and should not be taken as investment advice. And if there's one thing that we would like you to learn from this podcast is that you need to do your own due diligence, and you should try and keep learning as much as possible. And we aim to help you with some of that education, but this is not advice. We actually never got a chance to talk about Hallmark with my brother Chris, but that was my first purchase. It cost me $479 to buy. If you remember, it was $4.50 a share, about 100 shares. But at the time, commission was $29. I was using a discount brokerage. They called it a discount brokerage, although $29 seems pretty steep. The reason I bought Hallmark beyond the value proposition was also a total addressable market, or TAM, proposition. They had a new technology for stop signs, and it was going to revolutionize the stop sign industry. And at the time, it just seemed like such an opportunity because they would talk about the number of stop signs in North America. And you thought, wow, if they could replace every single stop sign in North America, that's a lot of revenue. But in retrospect, when you look at a stop sign, most of those have been up for 10 or more years. They're sitting there. You don't replace stop signs very often. And as it turns out, their technology wasn't widely adopted. They ended up writing off most of the funds that they had invested in that technology. So I purchased this at the age of 18 in 1999, and it was bought out. It was bought out less than 2 years later in year 2000. Now, I thought at the time that this buyout offer, which was $4 a share, less than where I had purchased it, I thought it was an outrage. It was a management buyout, and I thought the company was worth a lot more. I ended up attending the annual shareholders meeting, and I thought this was the start of my career as the next Carl Icahn. At this point, I don't think I ended up even saying anything at the meeting, owning only 100 shares and being at this time 20 years old. But in retrospect, getting bought out at $4 was probably a blessing, because right after that, the recession of 2001 kicked in. It hindered cross-border trade, which would have affected this company as a Canadian company that serviced U.S. clients. And the company did announce a bankruptcy in 2007, and I think is no longer in business. A total loss of $79 for my first purchase. Wasn't an auspicious beginning, but in retrospect was better than a loss of the entire amount. In our next episode, I'll detail a trade where I actually did make some money, and we'll hear from another guest what their first, their worst, their best, and their last trade was. If you'd like to get a hold of me, you can find me on the platform formerly known as Twitter, and I'm at Terry M. Hogan. Also, if you'd like to be a guest on Terry Hogan Talk Stocks, hit me up. My DMs are open.